Hey everyone, welcome back to Corporate Decoder, the place where we unpack and simplify the most important financial news for you. And let me tell you, this latest filing from Fidelity Commonwealth Trust is a doozy. It's like a treasure map of market movements and where the big money is heading, but don't worry, we're going to translate it all into plain English for you. We're diving deep into the May 31, 2025 semi-annual report for the Fidelity Nasdaq Composite Index ETF, ticker 1Q. Think of this report as a snapshot of what this massive ETF was invested in over the last 6 months. And let me tell you, it holds nearly $8 billion in assets, making it a significant player in the market. Let's break down where exactly this fund is putting its money. As of May 31, 2025, a staggering 49.5% of its assets were parked in information technology companies. That's almost half of the entire fund. Communication services comes in second at 15.1%, followed closely by consumer discretionary at 14.7%. It's pretty clear this fund is betting heavily on technology and the companies that engage with us digitally, whether that's through our phones or the things we buy. Delving deeper into the specific sectors, it really highlights how concentrated the fund is in tech. Information technology is a massive 49.5%, then communication services at 15.1%, consumer discretionary is at 14.7%, healthcare makes up 5.4%, industrials and financials are smaller slices at 4.5% and 3.8% respectively. Consumer staples, a sector often seen as a safe haven, is a mere 3.6%. Utilities and materials shy in at under 1% each, and energy is the smallest at 0.5%. This is a fund that's all in on growth and innovation. Across the board, 99.7% of the fund's assets are in common stocks. This means they own shares of companies. The remaining 0.3% is in short-term investments and net other assets or liabilities, which is essentially cash and other working capital items. This tells us the fund is fully deployed in the stock market, aiming for maximum growth. Now let's talk geography. The fund is overwhelmingly invested in the United States, making up 96.3% of its holdings. That's a huge chunk. Canada is a distant second at 1.0%. China follows at 0.7%. The Netherlands, Brazil, Israel, and the United Kingdom round out the significant country holdings, all below 1%. It's clear this ETF is a very strong bet on the American economy and its tech sector. The rest of the world plays a very minor role here. Let's look at the rock stars, the top 10 companies making up the core of this ETF. Microsoft Corp leads the pack at 11.0%. Then Nvidia Corp at 10.6%. Apple Inc. follows with 9.6%. Amazon.com Inc. is at 7.0%. Meta Platforms in Class A makes up 4.6%. Then Broadcom Inc. at 3.7%. And Tesla Inc. at 3.5%. Alphabet Inc. Class A holds 3.3%. And Alphabet Inc. Class C holds 3.3%. And Alphabet Inc. Class C holds 3.3%. And Alphabet Inc. Class C is at 3.0%. Meta Platforms in Class A makes up 4.6%. Then Broadcom Inc. at 3.7%. And Tesla Inc. at 3.5%. Alphabet in Class A holds 3.3%, and Alphabet in Class C holds 3.3%, and Alphabet in Class C is at 3.3%. Meta Platforms net assets talk about concentration. These are the giants driving the Nasdaq's performance, and this ETF is heavily weighted towards them. When we look at the detailed breakdown of the common stocks, it's heavily skewed towards the US, as we saw. For example, in the United States section, we see huge numbers for tech giants. Apple Inc. is valued at over $726 million. Microsoft Corp is worth a massive $824 million right now. Nvidia Corp is right behind at almost $795 million, $525 million. Amazon.com is valued at over $523 million. And Meta Platforms, the company behind Facebook and Instagram, is over $342 million. These top tech companies are the engine of this fund, and 20 behind Facebook and Instagram, $5 million. Amazon.com Inc. is valued at over $523 million. And Meta Platforms, the company behind Facebook and Instagram, is over $323 million. And Meta Platforms, the company behind Facebook and Instagram, is over $342 million. Amazon.com Inc. is valued at over... Across the globe, you see companies like Mercado Libre Inc. in Brazil, valued at over $31 million for consumer discretionary, and in China, JD.com Inc. is valued at nearly $4 million. For information technology in the Netherlands, ASML holding NV is worth a huge $15.8 million. And in the US, we have broad exposure to all sorts of tech names, including companies involved in semiconductors and software. The scale of these investments is mind-boggling. Digging into the financial statements, we see the fund's total assets were over $7.7 billion. After settling its liabilities, which amounted to about $167 million, the fund's net assets stood at a very healthy $7.56 billion. A significant portion of those liabilities includes collateral on securities loaned, meaning they are lending out some of their holdings to generate income. Now let's talk about performance for the 6 months ending May 31, 2025. The fund generated $26.4 million in dividends and over $3 million from its investments in Fidelity Central funds. But the real story is in the gains and losses. The fund experienced a net realized gain of over $44 million. However, the change in net unrealized appreciation or depreciation on its investments was a significant loss of over $88 million. This resulted in a net loss for the period of over $22 million. That means, despite generating income and realizing some gains, the overall value of the fund's holdings decreased during this period. Looking at the per share data, we can see how this played out for individual investors. The net asset value per share at the start of the period was $75.75. By the end of May 31/3/2025, it had decreased to $75.24. This translates to a total return for the 6 months of negative 0.33%. While not a huge drop, it does show that the fund's performance was slightly negative during this reporting period, reflecting the broader market movements and the specific performance of its tech-heavy holdings. So what's the verdict on this Fidelity ETF? It's a pure play on the Nasdaq Composite Index, meaning it aims to mirror the performance of that widely followed tech-heavy index. Its strategy is clear: invest in the biggest and most influential technology and growth companies, primarily in the US. This concentration gives it the potential for high returns when these sectors are booming, but also makes it vulnerable to significant downturns if those sectors falter. The fund's hefty investment in information technology and its massive holdings in tech giants like Microsoft, Apple, and Nvidia show a strong conviction in the long-term growth of these companies. However, the sharp unrealized loss of over $88 million indicates that the market value of these holdings decreased during the reporting period, even though the fund itself might not have sold them. This is a key distinction for investors to understand. Fluctuations in the market value of your investments are a normal part of investing, especially in growth sectors. To understand fluctuations in the market value of your investments are a normal part of investing, especially in growth sectors. With a tiny expense ratio of just 0.21%, this ETF is an efficient way to get broad exposure to the Nasdaq 100. The fact that the management fee is so low is a major plus, because as we know, costs eat into returns. The report shows their investment advisors have a very hands-on approach to ensuring the fees are fair and reasonable, which is always good to see. While the immediate performance showed a slight dip, this ETF is designed for long-term growth. It's a strategic choice for investors who believe in the continued dominance of big tech. Alright, that's our breakdown of Fidelity Commonwealth Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.